Good evening. Thank you guys very much for coming out. We really appreciate it. I want to take just a quick moment to thank our sponsors, Tulsa County Bar Association, OIPA, Apache, for helping us put this on, and a special thanks to the University of Tulsa Law School for sponsoring and hosting this event. They've been a great help in putting this all together. I want to introduce our speakers real quick, and then we'll kick it off. Our moderator tonight is Jeff Wilson. Jeff is the Vice President of Government Affairs with the OIPA. And then John Treblecock is the Chairman of the House Energy Committee at the State Legislature. We also have Bob Rock, who's Vice President of Tax with WPX. And we also have Barry Mullinex. He is the President and CEO of Panther Energy. Jeff?
Thanks, Drew. We'll just get started today, and what I'd like to do is just kind of open this up and begin with each of the panelists. Just have them talk a little bit about their specific areas. You'll hear a little bit today about federal issues, a little bit about state issues, and some just tax reform in general. So with that, I think I'll just start with Barry. Barry, why don't you just talk to us a little bit about your background and why you're here to talk about tax today, and kind of lead us into that.
Sure. My name is Barry Mullinex. I'm the CEO of Panther Energy. We're a small E&P company here in Tulsa with 95 employees. My background is in acquisitions and divestitures, not in tax, but I do make decisions every day based on the return on investment of what we do in exploration. And so taxes matter to us, and tax policy matters to us. So I'll be answering questions today mainly as it relates to the decision making in E&P.
Bob Rock with WPX Energy. We are a spin-off of Williams Companies, if you're not familiar with us. Almost 2 years ago, we had a spin-off of the upstream business. Williams, they retained their midstream business. I got to live through tax reform in the 80s, so I can talk about that a little bit. My focus is really on the federal issues. I did get David Wolf, our state tax manager, to come along in case y'all want to ask any state questions that I can't handle. For us, our basins are not that where we produce really are not Oklahoma. It's really we're focused Pennsylvania, North Dakota, Colorado, New Mexico. But the state issues truly do matter as well as the federal issues. Was with Williams a little over 20 years, a couple years now with WPX. Before that, public accounting, and spent several years doing tax in the retail industry.
Mr. Chairman, why don't you tell us a little bit about what policymakers see and how you guys deal with tax issues as they come up?
My name's John Treblecock. My district in the legislature, I represent primarily Broken Arrow. I've been in the legislature 11 years and am fortunate, or some days I consider it fortunate, to chair the Energy Committee in the State House of Representatives. Really what we do is, the tax issues don't usually come through my committee, but we still have quite a bit to do with it. There are a lot of substantive issues that we deal with, and you have to always balance what is not just necessarily appropriate for state coffers, but also for the Oklahomans who work in the industry. Since 1 in 6 jobs in the state are involved in the oil and gas industry. And I also want to point out, I've been griping about how envious I am of those of you who are students here. Whenever I went to law school here, this was not nearly as nice as it is these days. So it's always good to be back here.
Let's talk for just a minute. Let's start talking about federal tax reform and talk about what's been in the president's budget for now 4 years, going on 5 years every year, and that's the treatment of intangible drilling costs and percentage depletion allowance. And Barry, I want to start with you here. You've been involved at the federal level talking about these issues. Tell us a little bit about what you see on the federal level with IDCs and percentage depletion allowance and the challenges we face in preserving and protecting those provisions for the oil and gas industry.
Well, I just finished a 2-year stint as the Federal Issues Committee Chairman for the OIPA and spent most of that time in Washington, D.C. meeting with congressmen on both sides of the aisle and senators on both sides of the aisle. We were working to try to protect our federal incentives that we get, but what we ran into mainly was just a brick wall in terms of people's opinion of the oil and gas industry, people's knowledge about our tax incentives, because everybody on the left claims that they're all subsidies, but we don't get a check from anyone in the federal government. We have to spend millions of dollars to get the deductions that we use. So what I saw was President Obama's administration push at least 8 times, I think, for the repeal of all IDCs, depletion allowance, and other tax incentives that we get at the federal level. In the face of that, luckily, I think we were, in spite of those headwinds, we were able to discover this massive wealth of shale gas and drive prices down, drive costs for everybody down in energy. And now the entire administration is on the bandwagon and pushing for at least the natural gas part of the narrative, but they're still pushing to repeal our IDCs and other tax incentives. The problem with that is that once you mess with tax policy, everything changes. The IDCs have been around since 1913. So we've been getting into annual drilling cost deductions, which are basically just normal, ordinary business deductions. But because of the risk and the magnitude of what we do, we get to deduct them in the first year instead of 5 or 7 years like every other depreciable asset that everybody else gets to deduct. But it isn't a subsidy. So, you know, I think that we got caught behind the 8 ball when President Obama became president and just basically attacked our industry from the very get-go, and we weren't prepared for it. I think that we could have informed the public for years before that on issues related to oil and gas that would have probably saved us a lot of heartache and headache in the last 5 years. But we've done a good job since then. I think that most people realize that oil and gas has been a key driver to the recovery, the economic recovery of the United States, and it probably will be for the next decade or more based on the reserves that we found. And I honestly, in my own opinion, I think that we haven't even scratched the surface of energy that we're going to find in this country.
Bob, you mentioned that you were around in the 80s for a similar discussion. Talk to us about, you know, what mirrors the 80s and the discussion today, kind of what some of the pitfalls were when we had these tax reform discussions in the 80s, and what you see going forward with tax reform discussions here, you know, in 2013 and beyond.
Well, first of all, I was a lot younger in the 80s. So I had a real different perspective. But in the 80s, I kind of thought of it, it was kind of like creeping tax reform. Reagan became president in 1980. We had a significant tax bill in 81, 82, 84, 85, 86, 87. You know, and so all of that combined really became tax reform. Now, 86 was the big legislation, so we refer to it as the 86 Code. But things that you hear of today, makers depreciation, well, in 81 it was acres. You know, we went too far and had to modify it and call it makers. IRA deductions, you know, what we're doing with 401ks today. I mean, so much goes back to those days. But the real linchpin of what they were doing was lowering both individual and corporate rates. At that time, individual, the top bracket was at 70%, I think, and the top corporate rate was 48, I believe. So we brought the corporate rate down to 34 for just a year, and then back up to 35. And then the individual rates brought them down in line with what the corporate rates were. You know, so there's a whole different driver of what they were trying to accomplish. Actually, there were quite a few incentives given to business back in the 80s because there was the real interest of spurring the economy. We were going through a real estate crisis back then. But there was a willingness to work together. You know, you hear a lot about that today with Tip O'Neill and President Reagan working together, but you really did see that. And so there was a lot of compromise that went on in order to get the tax legislation out that was needed. And that's the difference that I see today. You know, the time that I spend talking to the folks in Washington, and I know a lot of the feedback I get through API and other organizations. It's just the fact that the two sides just do not want to talk to each other. And so you have proposals going both ways. It can be fairly draconian, depending on which way you go. In terms of IDCs, the only thing we've had to look at so far is what's in the president's budget proposals each year. So there's a lot of talk about IDCs, but no written proposals that anyone can look at and comment on. The president's proposal says that IDCs will become just depletable property. So you may take IDCs that right now we're deducting in year one, and instead spread them over a 30-year productive life of a well. Well, that is an incredible change that you just can't absorb, without significant transition rules. And really, that kind of change is just more than anybody can really absorb. But that's the only proposal that's out there to date. I get a little bit frustrated that IDCs are called a loophole. It's been the law for 100 years, and now it's a loophole. There's a lot of political sound bites going on around IDCs. When you look at the revenue marks in the president's budget, IDCs are really pretty moderate compared to other items. When you look at it, we'll see it on a slide here in a minute. When you look at what they call the tax expenditures, what they call the government givebacks, where you start with just a baseline of everything's equal, but then government's going to give incentives for certain areas. IDCs are just way, way down the chart, but it makes good political sound bites, and we're getting a lot of that now because the energy industry is not in favor with the administration. And I guess one last quick point I have to make, because there are now revenue marks from the president's budget, the energy issues, including IDC, kind of become everyone's favorite revenue offset when they've got their own legislation that they want to push through. So we've had several instances where people have come and proposed legislation totally unrelated to anything related to the energy industry. What they're paid for are the revenue marks that they see from IDCs, percentage depletion, manufacturing deduction, those things such as that. So even without tax reform, there's true risk for the industry because there's a revenue mark now. And people see that revenue mark and they see that, okay, that's available for me to offset my legislation.
Just sticking with IDCs and percentage depletion allowance, Barry, you might talk a little bit about that here in a second. Just kind of sticking on the theme of the federal taxes, that some of the transitions that we're in now and some of the political reality we face. It's not just the president that is looking at IDC and percentage depletion allowance now. You have some folks in the House that are starting to look for it to talk about tax reform as a whole. And there's a real theory that we're going to flatten and broaden the tax base out, and we're going to get rid of all these deductions and exemptions and what have you. What do you see from a corporate perspective? Will that work? Can you get the rates down low enough, the corporate rates and the individual rates, to account for all the elimination of, say, IDC and percentage depletion allowance?
Personally, no. I mean, not where they want to take the rates. Once again, when you look at at least the revenue marks they have on the different tax expenditures, the most expensive thing is the accelerated depreciation makers. They're going to have a hard time touching that, because there's going to be a tremendous outcry from a very broad group of you're taking away our depreciation deductions. And you just have to kind of look at the list and say, okay, what is it that you're going to take away in order to lower the rates? International is a big issue, and there's a lot of dollars there. But there's only 3 or 4 business issues that really have significant dollars that they can look to. The significant dollars are on the individual side of the equation, and that's voters. And so it's your health care insurance, it's your 401k. I mean, those are the big dollar items that are out there, mortgage interest deduction, and politically very, very unpopular to go touch those. So, somehow to say that I want to lower rates but keep revenue the same, you got to look at those expenditures to make that happen. We'll have a slide with some of them.
For us, we started drilling horizontal wells about 20 years ago. And, for us, the tax issue is one of cost, because today we spent $200,000 drilling a horizontal well 20 years ago, and we spend $3 to $10 million drilling one today. just because prices go up doesn't mean that we reap an incredible amount of profit between the time that prices go from $95 a barrel to $105 a barrel. Costs go up incrementally as that happens. So as soon as the prices go up, drilling increases, costs go up, so our margins go down. And unlike other assets, you know, I can refill this glass of water when I get thirsty again, but I can't refill an oil well. Once I've spent those millions of dollars and it either completes and produces for 50 years or something goes wrong with it during that 50 years and it breaks and tools get stuck in the hole, and it's only 5 years later that I've lost all that investment. That's the real reason that IDCs are deductible in the first year. And when I tell people that we reinvest over 100% of our profits every year, they say, how can you do that? And the reason is that because of IDCs and depletion allowances that allow us to because we have a depleting asset. Once it's gone, we have to continually drill more wells to earn more profits as our company grows. So the taxes allow us to reinvest more than we make every year. And our company has, for 10 years, reinvested over 100% of our profits. And that's the only way we can grow from having 100,000 barrels of oil in total reserves to 1 million barrels of total reserves over time. That's how Williams does it. That's how everybody else does it. And, you know, the bigger you get, the IDCs have a lessening effect. But for investors, our first 10 years in business, we derived a lot of our capital from private investors. And because of the risk involved in investing in oil and gas, they could get the IDC deductions on the money that they invest. And today, you know, a very small percentage of our money comes from outside investors, but 10, 15, 20 years ago, half or more of our investment came from that. So you take away those deductions, those investment dollars dry up completely if they don't get the deductions. So.
Turning just really quickly here, transitioning over to the state is going through some similar things. The legislature is looking at the tax code and has been in the process of reforming the tax code for several years now. And you know, part of that has kind of come up, and the oil and gas industry has been mentioned a little bit. Can you tell us kind of what you see at the legislature now and talk about some of the provisions that impact oil and gas?
Sure. One of the a little bit different factor in the decision-making process on the state level than the national is we're obviously in competition with companies that are multi-state companies with other oil and gas states. If we don't have a favorable tax code here for investment, they're going to, and they have a fiduciary responsibility to their shareholders to go invest in other states. And here in Oklahoma, the gross production tax is really the big issue. And a little background on that, it's 28% of the state budget last year came from the gross production tax alone. Before 2010, that was a 7% rate of taxation, and that was a little bit of playing funny numbers because then you would rebate part of that back to the companies, which made it look like the state had more money in its coffers than it actually did. But when the 2010 recession came along, it was pretty draconian. There were a lot of draconian cuts, which would have been even more draconian if it had not been for the oil and gas industry being willing to step up and offer to, in effect, loan the state my tax code, I guess is the simple way to put it. And they lowered the rate. It's kind of complicated to explain, and Jeff can probably do a better job of that. But in essence, that deal is coming to an end next year. And the question is going to be, what are we going to do with the gross production tax? Some people in the legislature would like to let it go back up to the 7%. There wouldn't be a rebate, which is a pretty big increase, and I think would chase some investment capital to other states. And as policymakers, my colleagues, there's a lot of pressure on us from voters, from constituents groups, who they look at the oil and gas industry as this pot of gold from which they can fund all the other needs that the state has, not understanding that when you're talking about 28% of the state budget, 1 in 6 Oklahoma jobs, 300,000 people, you tinker with it too much, you may chase it away. So it's a tough balancing act, and one that hopefully we get right next year. It's a critical year.
doesn't the legislature kind of look at some of those provisions and talk about doing some of the same things that they're talking about on the federal level, streamlining, eliminating some deductions, eliminating some provisions like the 1% rate that we have on horizontal wells for 48 months, and then it goes to 7. How does that discussion happen at the state level? How do you actually get into that process and decide what makes it a good tax provision, what makes it a poor tax provision, and what should be eliminated and what should stay?
Well, the honest truth is, I don't know that the vast majority of my colleagues really grasp it. They kind of have a general idea of the importance of the industry. It's really more of a small group that really gets into the details and understands that. And that's why groups like OIPA are so important in the education process. And people that are in the industry who have knowledge need to be involved and to educate their individual legislators as to what they consider good policy. Because believe me, there are plenty of people outside the industry giving their view of what good policy would be. It really often, unfortunately, comes down to the last few weeks of the legislature. We have 4 months in Oklahoma, February through May. And just like most of the students here probably do, the cramming the finals week, a lot of real decisions are made in the last week or two, which doesn't necessarily always make good policy, but you see the deadline coming, and that's where deals are cut, and it's sometimes surprising we do as well as we do.
Barry, from an operator standpoint, what do tax provisions in the state look like for you? How does this 1% for 48 months on a horizontal well, how does that impact an operator and a person that's looking for investment, deciding where to deploy capital?
Well, first of all, when we model to drill for oil and gas wells, we do it from an engineering standpoint, and we run economic models of looking for a 15 or 20% rate of return on each of our wells. And if the porosity cutoff and a number of other factors fed into that model show that it will get to that return, then we move forward to the next step in deciding whether to acquire or drill a property. But the base model that we do does not include the tax rebate. What we do is we run sensitivity cases, price sensitivity cases to see what will happen when price goes up, when price goes down, and then we run sensitivity cases that plug the tax rebate. And by the way, it used to be a rebate, it's a deduction. Everybody thinks this is a new tax that was instituted, a new tax break in 2010. We've been using this for, since the early 2000s, the horizontal tax credit. But then what we do is we plug those numbers in and we analyze all that data and then decide whether to go forward with a project for a well or leasing acreage. But I can tell you that back in June we sold our biggest asset, which covered the Texas Panhandle, over 300 wells in the Texas Panhandle and the Oklahoma Panhandle, to Mid-States Petroleum here, who has an office here in Tulsa. In the economics that were used to establish the price of that asset, the tax credit was in there. So it factors into decision making beyond just deciding when to drill. We had a company in Houston, as you were just saying, John, that actually moved up here, opened an office, hired 64 of my employees, they plan to put in another 100 employees here in Tulsa, and their economics that they used to purchase the asset included the tax incentive. So it's very important.
So when you guys look at tax policy, how important is stability, and do you guys consider a stable, fair, and effective tax rate when you make those sorts of policies? Barry, how important is that stability to those companies that are purchasing assets, but also like you starting a new company and looking to pick up assets here in Oklahoma?
Well, we did just start a new company and raised $450 million to start another company here about 3 weeks ago. And one of the issues that we will look at in buying assets, especially in Oklahoma, will be the tax credits and other incentives that we can get to push our returns over that 15 or 20% hurdle rate. And honestly, everybody thinks that we're easy guys to pick on, and everybody thinks we have huge margins, but Apple, Google, all those guys make more percentage on the dollar profit than we do. our margins get slim, especially as costs keep going up. And as I said, our average well cost, yours are probably higher than ours, but our average well cost in the Texas Panhandle is $3.5 to $4 million a well, and up in the Bakken, they can be $15, $20 million a well to drill those. So tax policy becomes very important. And by the way, there's 27 states that have zero severance tax on oil and gas companies, either because they don't have oil and gas in their states, or they just haven't put one in place yet. But the rest of the states all have a severance tax, and Oklahoma ranks in the middle somewhere when you include other taxes that we pay. It's actually a fallacy to just compare our severance tax or our gross production tax to other states to see how we compare, because every state has other taxes that affect everybody. For instance, we're an LLC, so everything in my company flows through to me personally because I own shares in the company. So not only is my company paying a state severance tax, but we're also paying personal income tax in the form of an LLC and corporate tax. So it all adds up, and it adds up for everybody that's in our industry too, because we have one of the highest income states in the country when it comes to energy jobs. So everybody's paying a lot of taxes.
How do you guys at the state legislature look at stability? How does that impact the decisions you make? I know our industry here impacts a ton what the state has to spend at the end of the day. Does that go into your decision-making calculus? Do you look at what's happening in the industry and say, this is a fair way to proceed? Is stability something you guys consider?
Well, I mean, it's not like we all have the same mindset. I mean, business-minded legislators do, and they recognize the importance of stability and investment-making decisions. As I said earlier, there are different interest groups and competing groups that have different ideas how things should run, and different legislators from different parts of the state or different backgrounds respond differently to those groups. So it's a marketplace of ideas, and you have to try to get in there and make people understand the importance of those kind of factors as you make those decisions.
We've heard some statements from some public officials, the Secretary of State of Finance and others, kind of advocating for a change in the gross production tax. What do you see in the future? What do you see in this next legislative session, and maybe even beyond, with respect to tax reform?
Well, one thing that we all learn in 8th grade civics, but sometimes we forget, is there is a House, a Senate office, and for anything to actually happen, you have to have a consensus, at least with the majority of the House, majority of the Senate, and the governor then has to sign the bill. Because on issues like this, you're hardly ever going to get a supermajority to overcome a veto. So it's like I said, some of the Senate seem to have the idea that flattening the rate but raising it would be the way to go. I don't necessarily agree with that, but it's going to be an interesting session as far as this goes. I think that I agree. On the House side, Speaker Shannon has said that he doesn't want to do anything that hurts the industry. So that gives me confidence that we'll have a good product at the end of the day.
Let's kind of shift gears again once you get to the federal level and talk about what you see in the future. Bob, I mean, you've lived through this before in the 80s. Tell us what you see on a go-forward basis here with tax reform. Barry mentioned pass-throughs. I mean, are we changing how we're approaching tax reform from the big corporations to pass-throughs, and are we changing it for those companies, and are we leaving some companies behind? How is that going to happen for us in the future at the federal level?
Are you segueing to the slides? I have some slides on that actually. So actually, pass-throughs are becoming huge, particularly with the MLPs now. But there's been just an incredible shift. Once again, it's driven largely by what's happened with tax rates. Certainly back when we had that 70% individual tax rate, everybody wanted to keep their revenues in the corporation. As rates were equalized, you started seeing the shift towards pass-throughs. I always think it's interesting in the 80s when MLPs first started, and the first MLPs, wasn't by law. It was just simply that they came up with the idea that because of the lower tax rates, we could do a publicly traded corporation or partnership. And the Boston Celtics were an MLP. You had MLPs in all kinds of different businesses, and Congress got concerned that the whole thing was going to move to partnerships, so they, in '87, they put a stop to it and said that only certain industries can be master limited partnerships, which primarily is energy now. But there's been a huge shift to pass-throughs. Of course, one of the basic things in U.S. tax is that we have double taxation of corporations, which you kind of shake your head when you think about that. But there's just a lot that happens over that issue of as Barry would tell you, being in an LLC, it gets you out of that double taxation realm. That's one of the big drivers with the MLPs that are out there. And I also have to mention, back when I started practicing, there was no such thing as an LLC. Those are fairly new on the horizon. So they've been very interesting because you won't find LLCs discussed in the tax law. An LLC is either a partnership or it's a corporation. You have some choices that you can make. But the state laws around LLCs have been extremely favorable to tax planning, to being able to set up pass-throughs, but yet retain some protection, some state law liability protection. So, it's interesting how those changes have happened in just the last few years.
Barry, prognosticate for us a little bit. What do you see coming out of federal government?
Nothing. I think as long as you have Boehner and Reed and the talking heads up there that will never see eye to eye. They're both being pulled by different factions of their respective sides. I think that, as you alluded to with Reagan and Tip O'Neill, and Reagan did leave IDCs alone, but he did other stuff to us. But there was a huge bipartisan effort that worked, and we did get tax reform, and it did lower the tax rate, and it did clean up a lot of stuff that has since built back up in our tax system, and we have a horrible tax system. But I don't see anything happening in the next year or two. I think tax reform is a grand illusion. These guys, after spending 2 years going up there, I don't think that they're any closer to that issue than when I started 2 years ago. I do see that, from our perspective, that what we've done in the growth of the energy sector in the United States has helped pull the country out of recession, and we're one of the only sectors that hired the entire time the recession was going on. And we currently employ 8 or 9 million people in this industry across the country. But what I do see is that we've indoctrinated and helped bring in a lot of support from states that weren't normally oil and gas states. We met with a Wisconsin congressman when we went up there one time, and he was a Democrat, and we thought we were going to have some, run into some issues in discussing our issues with him, and he said, "Man, I love you guys." He said, "We don't have any oil and gas in Wisconsin, but we make the best damn frac sand you've ever seen." So Wisconsin is supporting the energy boom in the United States because their revenues are up, their unemployment's down, they don't have budget issues like some other states do. So what's happened is that we've grown a lot of support. So I think that there are more people who support what's happening in this energy renaissance. And I think it can continue for a few years. But as far as what's going to happen in Washington, I don't see, unless you get a turnover of the leadership in the House and the Senate, which won't happen until the midterms in 2014. That's the key. If it goes to a Democratic House and Senate in 2014, then we're probably going to lose a lot of incentives. Investment will dry up in our industry. Oil prices will go up. You guys will be paying $5 or $6 a gallon for gasoline because we'll be drilling less of it without the incentives that we get. But if it goes Republican, then the president's still going to veto everything that we try to put in front of him. So I'm not sure that it's so bipartisan today up there, and as usual, the pendulum usually swings to the extreme one way or the other in politics and in Washington, D.C., but right now it's probably as bipartisan as I've seen it in my entire life, and some of you guys may have the same feeling. And the politicians seem to be here and here, and all of us level-headed people are in the middle. So, you know, it's up to us to make choices in 2014 when the elections come around, and maybe that will help spearhead some bipartisanship.
Can I comment on
Yeah,
that?
absolutely.
You know, the reality that we have today is that tax bills are supposed to originate in the House. The chairman of the Ways and Means Committee is Dave Kemp, who's a Republican. The Republican caucus has a rule where they can be where you're term limited to be chair of the committee, and Dave Kemp is currently term limited. So this year, next year, or his last year is heading the Ways and Means Committee. On the Senate side, Max Baucus is head of the Senate Finance Committee, recently announced his retirement, so he's lame duck. And of course, we've got a president who's lame duck. Those three people are really the keys to trying to make tax reform happen. You know, it's not Speaker Boehner really that's at the table with them. It's really Dave Kemp that's on the House side. And then, of course, next year are midterm elections, and it's always unpopular to try and push tax legislation in an election cycle. So there's a fairly narrow window. Kemp has assured us that there's going to be some type of tax bill reported out of committee before the end of the year. You know, we'll see. He promised it this summer, and we didn't get it. Baucus is saying the same thing. But they're really having a difficult time getting coalitions because, once again, you got a Congress that they're trying to wrestle with immigration right now. They've got a debt ceiling again, and they've got all these other issues that keep them from dealing with tax reform. And tax reform takes a lot after they're going to do it, and I just don't know that they've got that ability with everything else that they're struggling with.
Well, you both kind of mentioned the short term here. What about after that election? What about in the long term? Is tax reform a discussion that we're going to have for a while? I mean, is it just going to go away after this next election cycle, or are we going to be here having this discussion in 2, 3, 4 years?
I want to add to what he said. You know, I think one of the big issues that Baucus and Kemp have as they try to move forward is they both propose what they call a clean slate tax reform proposal, which meant that you throw everything out the door, every tax incentive that every industry gets, and you start with a blank piece of paper, and then you add them back in as those industries or groups justify those tax incentives, which to me seems like you know, starting over, and that's going to be very difficult, like you said, for them to get that done in a shorter period of time. In a longer period of time, I just, like everybody else in this room, have hopes that we can elect some people that can get along and work for what's best for everybody and not just on getting reelected.
And I think it depends on how you define tax reform. You know, our first codification was in 39, then we did one in 54, we did one in 86, so it's about time, but every time we've redone the code, it's gotten bigger, not smaller, you know, so.
Right. Blank slate approach is great if I'm in the deal, but if I'm not in the deal, it's not so good, right?
Well, it's really a great fundraising tool for politicians is what it is. You throw everything out, and that's a lobbyist full employment act right there.
I'm for that deal. Well, what about on the state level? You know, we have an election coming up in the next year on the state level, and you just heard that tax reform is kind of impossible in a federal election year. In the state, do we face similar difficulties in trying to reform the tax code? Are the pushes still going to be there in this year? Or are we going to wait until, you know, after the 2014 elections before we have that discussion?
Well, it's obviously a different dynamic in that you don't have, I mean, it's currently really a one-party state with a Republican governor, 72 Republican members in the House, and 36 Republican senators. Doesn't mean that they all agree, however. They still have different ideas. The real push has been mainly on the state income tax, bringing it down. We passed a bill this past year lowering it, but not this upcoming year, to put it off for the year after that. You know, I think things will get done. I don't think that next year's election really will impact it one way or another. I don't see it any real challenge to the governor, and I don't really see any numbers changing in the House or Senate. So, for the most part, the same players will be at the table in 3 years and they're over there now.
Are we looking at a scenario where you have a state budget and some headlines will tell you that the state budget's shrinking, some headlines will tell you the state budget's growing, but when you push on that balloon, it has to move somewhere, right? So are we looking at a scenario when you cut the state income tax that you have to go find revenue elsewhere? And if so, does that come back on us?
Well, I mean, you're right. We'll go through a period of 3 months where saying state revenues are above what we expected, and then suddenly you'll have a couple of months where wait, it's not coming in like what we thought, and everyone blames each other for that. But the fact is, I've been in office 11 years. When I came in, our state budget was $7.2 billion. Then it went down to 6, then 5.8, now it's up to 6.1. I mean, we're still here. And again, bring it back to the energy policy alone. I can't overstate. And something most people in Oklahoma don't understand is 28% of the tax revenue in the state comes from oil and gas industry. I'm a former high school teacher. Whenever I was in law school here, I taught high school, so a lot of my former colleagues are always pointing at these guys as the answer to our educational funding issues, which we undoubtedly have. But whenever I walk them through, well, the money that's paying for what we do have is coming from these guys. It kind of gives them a different outlook at it.
Well, I wanted to take a minute, and as we kind of get close to the end of our time, we have a lot of folks in the room, a lot of folks that obviously care about tax, so I kind of want to look to you guys and see if there's a couple questions in the audience. I see one hand already. Just kind of, if you have a couple questions, just throw them out there, sir.
I wanted to clarify this, the current gross production tax in Oklahoma. As I understand it, on horizontal wells, you get a 48-month holiday on everything over 1%. And we won't get into the the rebate and the loan and all that business. So for 48 months, you have a 1% gross production tax. And as everyone knows, the decline curve on most of these horizontal wells, particularly the Mississippi and a lot of Woodford and some of these, is horrendous in the first 48 months. As I understand it, North Dakota has an 11% gross production tax, or 9 to 11%. And so there may be 27 states that don't have any, but there are a couple of states that have a substantial gross production tax. And for Oklahoma to have a 1% gross production tax, and effectively it seems like that's what it is. I mean, 48 months out is a pretty long time when you're looking at the decline curve on these wells. For Oklahoma to have a 1% gross production tax, when the rest of the oil-producing states are well above that. In fact, I think, does California not have 7 to 9%? Seems to put the onus on the oil business to belly up to the bar and try to help Oklahoma out of the problems that it has, which is the lowest per capita investment in high school students in the nation. So I think the gross production tax ought to be revisited, and I agree that the federal position on IDC is ridiculous. We've had it since 1913 and oughtn't to be changed and so forth. But as far as the gross production tax is concerned, I don't see how the oil companies can justify the 1%.
Anybody? Barry, you want to?
Sure. Well, first of all, the effective tax rate of the 1%, if you average it out, some of these wells can last 20 years, some of them 50 years. So it's probably more like 3% is the effective rate of the tax. There are states that have more, but as I said earlier, North Dakota and other states don't have road use taxes and other taxes that we pay here. So just that one tax is not the total tax that this industry pays in the state of Oklahoma. We pay a lot more in taxes, and somebody needs to put together a study that shows what the total taxes compares, because it is a misconception to just take that one tax and compare it with North Dakota or California and other places. Secondly, when we drill horizontal wells, as I said earlier, the cost is phenomenal. And that is one of the reasons that the tax rate, that we have this tax, the 1% for the first 48 months. And yes, that is...
You were mentioning yourself, though, the tremendous cost of the Bakken wells. And the Bakken wells will run $10 million. A Mississippi well in this state will run $3 million. They're all
Except the Bakken well will produce 4 times the oil that a Mississippian well will. So they're getting bigger rates of returns on those wells, even as they're spending more money. They wouldn't be spending 4 times as much as we do if they weren't getting at least 4 times as much of the crude oil out of the ground. They have to have a return on investment to do it. And yes, and I guarantee you that North Dakota will revisit their tax structure. North Dakota will they're considering changing it. In fact, there's 8 or 9 states in the country that are currently considering changes to their tax rates. We get a tax, half the wells we drill are in Texas, and we get a deep well tax credit there, but it's based on your BTUs. It's based on whether it's an oil or a gas well. Right now, the tax leans toward liquids, so we get a tax rate whether it's horizontal or deep well.
What is your effective rate down in Texas for a comparable horizontal or deep well? What would it run?
It's probably 5%. If you take the credit we get against the severance tax that they have in Texas, it's probably 5%. We drill a lot of wells in Oklahoma, and as John said, it entices a lot of people to come here. And one of the reasons that we do have these tax breaks is not just so that we can make more money, it's to incentivize additional drilling. We did a study, which I shared with Jeff the other day, of the wells that we would not have invested in the last couple of years had we not had the tax incentive, which is really what you're asking me. And it came out to 6 wells out of 150 wells. So you may think that's an insignificant number, but if you take 6 wells at $3 or $4 million a well, that's a $20 million impact to the state of Oklahoma just from Panther Energy. Now you multiply that times the Devons, the Chesapeakes, and everybody else, and all of a sudden you're going to have an impact to the economy of the state of Oklahoma if you take it away. Because, as I said, this tax credit, like IDC's, goes back years. It's not a new tax credit. It was a rebate that was turned into a tax deduction to help the state not have to write checks out of the Treasury. And one of the things that's happened in the last few years is we filled the rainy day fund up when it was $2.30. Today it's $500 million.
I think there's some confusion there. As I remember, David Hall came in and imposed a 3 to 7, moved the gross production tax from 3 to 7%.
5 to 7.
Is that about correct? And then what we did is in a couple of years ago, we took the 7% and gave the holiday for 48 months and reduced it to 1%. And then the oil company.
But before that, we were getting a rebate. The state was paying us a cash rebate based on how much money we spent on the well.
We didn't have the money to write those checks.
Yeah, we changed it. We were already getting a rebate of up to 3 or 4 years based on, and we were recovering some of the percentage of the cost of the well. It just simply switched from a cash rebate to a tax deduction, but it's still there. It's the same.
But I mean, when the smoke clears, what is the oil company paying on a deep or a horizontal well in terms of after rebates are washed out and everything? How much are they paying in the gross production tax? Is it not 1% on the first 48 months?
Yes.
Okay.
Yes.
So
the effective rate on a horizontal well is 3%. There's a different tax credit for deep wells that go deeper than 15,000 feet. And yes, you can argue that horizontal drilling is the norm today, but we probably wouldn't drill as many horizontal wells. In fact, you could argue that the reason that we have so much money that we're able to provide 28% of the state's revenue is because we did have the tax credit. And it continues. Now, as we go deeper into drilling these shale gases, we're going to drill up all the easy stuff in the next few years. Don't let it fool you that this is a never-ending supply of gas. It's not. And we're going to drill up all the easy stuff in the Marcellus and the Bakken. There's sweet spots, and they're going to be drilled up, and then we move out to the margins, and we drill less economic wells as time goes by until some technological change comes along to allow us to get more out of it. Just as an example, a vertical well can typically get 10% of oil in place out of the ground. Going to horizontal ups that from 10 or 15% to maybe 25%. 75% of the oil is still in the ground. So unless there's another technological change, which there might be, and that incentive allows us to keep reinvesting not only in the research, but also the ability to drill more wells.
Barry, who pays gross production tax? I mean, is it just the operator that's paying the gross production tax on the well, or who all pays the gross production?
Well, yes, it's the operator, but we pay a severance tax, so does, and all of the service companies that work for us all pay different taxes that all add up to the tax base that goes into this. It's not just us that's paying the tax.
I think everyone who owns an interest in the production, including the royalty owners.
That's right.
Everybody pays too.
And in Oklahoma, isn't the producing oil and gas property exempt from local ad valorem tax?
Yes.
And in many states, there's a gross production tax and an ad valorem tax. I agree with Dobie. I think someone needs to do the study to find out what the true effective rate is in Oklahoma and how it compares to other states. And why would you favor horizontal drilling over other forms of drilling? Is that part of the policy here? Because we want to encourage horizontal drilling rather than vertical drilling?
Well, it's less surface locations. You have less environmental impact with horizontal wells. In fact, in the state of Oklahoma, one of the issues that's before the legislature right now, which Jeff can probably get into more detail on, is the extended lateral and spacing units. Right now, we can only drill to the limits of a spacing unit in a section that we're drilling in, which is only 1,500, 2,500 feet. In Texas, I can drill a horizontal well 10,000 feet, 12,000 feet, any length I want, but I can't do that in Oklahoma. The economics would actually be better if we could. Also in North Dakota, they drill 4, 6, 8 wells off of one pad.
But those aren't tax issues.
But they
Those are regulatory issues.
Yes, but they also impact our return on investment and our need for tax policy.
Just to clarify, horizontal wells aren't the only wells in Oklahoma that have tax benefits. There are other types of wells, be they deep wells or directional wells, that have tax provisions as well.
First of all, I'm not saying that I think that it's the only way to get a tax deduction for what we do. No one has approached our industry yet about a proposal to say, let's do it this way instead of the 48-month holiday that we get. And if somebody does, we'll be glad to discuss that with them. But we haven't had any.
Well, I had one other question. How, as far as the federal number on IDC, I mean, I agree with you that it's talked about as a big subsidy and so forth. How much would it really gain the government if you went to, let's say you went to a 4-year accelerated depreciation on oil wells, or I mean, what is the number that is allegedly involved in eliminating the IDC?
Well, the revenue mark that they have out there, it's been anywhere from $10 billion to $13 billion
a year.
No, and that's over a 10-year period. Once again, the way budgeting works, it's a 10-year static look at revenues, and so that's the only revenue mark that we have from the government side. Now for us as a company, and I'm sure everyone else, I've tried to run models as different ways that I can to look at if I had to deplete instead of get the deduction, which is just let me tell you, it's a horrible answer. If it's a 5-year straight line amortization instead of current deduction, it's still without significant transition rules. It's the punitive part's really in the first 5 years that you get into it. And then eventually your amortizations, whatever the period are, catch up with each other, and so you're getting what's close to a full deduction like what we have today. But the number of wells that it would cause you to not drill is just amazing, because companies like us, I'm sure most independents, every free dollar of cash that you have is going back into the ground. And when you get into the state issue, we have a certain amount of capital that our board approves for us to spend, and then we have multiple basins where we have leasehold interests that are competing for that capital, and the state issues do factor into that. I'm not going to say that they're the decision point, but still in the models that we do of each of the different basins, we've got the production taxes, we've got the income taxes built into those, so that we're looking at the after-tax return. for a type well, and just just deciding based on that, really where do we get the best return to drill. But
What's the tax number on the depletion allowance?
percentage depletion runs about the same. It's interesting. The biggest dollar issue for energy is LIFO. LIFO.
LIFO.
You think that's an issue for retail, but for the refiners, that's a huge issue. So that really surprised me when they came out with the energy marks and you've got LIFO staring at you and all of that. But percentage depletion is a true repeal. IDC is just a timing. And once again, what the government's doing is they're making most of that money within the first 5 or 6 years, and then down the road it starts leveling off, and it really hasn't brought in any new revenues. But it just accelerates it.
We're just about out of time. Just to be respectful of everyone's time, I want to kind of keep it close to an hour as possible. We have one more question. I think we'll probably wrap up after. Okay, we've got a lot of questions. If Drew will tell me if we can do more than one, if we can keep them quick, maybe. So, yeah, and these guys aren't going to be too far away from the bar either, so you can probably grab them. Just one more.
Questions for Mr. Trevelcock.
Sure.
We had a speaker here on campus a few months ago, and she wasn't focusing on Oklahoma, but she was focusing on the great idea that to engender enthusiasm for oil and gas companies, we need to move more to the model where the revenue is given back directly to the citizens, like they do in Alaska. Mm-hmm. I just wondered if that was on the plate at the Oklahoma legislature.
No. I think with that we're probably going to wrap it up. As I said, the panelists will probably be down at the bar. I'll be down at the bar, but I will not be taking questions. I'll be taking drink orders. With that, I want to turn it over to Drew just to kind of close things up. Drew.
Thank you guys very much. I want to thank Jeff for doing a great job moderating, our panelists, Representative Trevelcock and Bob and Barry for taking the time out of their day to do this. The receptionist downstairs, and they'll be happy to field more questions or defend a tax, whichever the case may be, whichever your position. So thank you guys very much for coming. Don't forget the CLE. You can sign out up there. Thank you very much.